I've got a lot of questions about what cash is in investment accounts recently. It can be super confusing. So that's what we're going to cover on Ask Alex Anything today. All right. So lots of different types of cash in various investment products. One of the most important ones to point out is cash available. This is actual cash money that can be distributed immediately without any liquidations or any transactions. Okay. This can come in different forms depending on who your custodian or broker dealer is, where your investment accounts are. But generally, it's going to be cash and then a dollar amount. Nothing else there. And that's spendable cash in a portfolio. Cash alternatives in your asset allocation can mean a number of different things depending on who your custodian is. That will be the spendable cash plus various cash alternatives, which can include ultra short duration ETFs, short duration treasury bonds. It can also mean money markets of various types, which some are taxable, some are not. There are municipal money markets available as well. But in any event, cash sweeps, cash available, cash money markets, ultra short duration treasuries, all types of cash alternatives. Conceptually, they're the same in that they're extraordinarily safe from volatility in the market, albeit they're not in an actual FDIC insured and bank. They're not technically insured, but they're all very, very safe types of investments. Now let's move on to the yield component and what these types of investments also pay you on a monthly basis. Generally, the actual spendable cash is going to have a very, very small yield component to it, depending on the custodian or broker dealer that's holding your investment account. It can be anywhere as low as 0.1% or as much as 1% for some custodians that provide an extra bump for new investments. In terms of yields on money markets, the tax-frees can yield anywhere from 2 to 4%, depending on the structure and the state you live in. Taxables are broken down into various types. Money markets can range from the highest risk, which is going to be your retail, and then you get government agency backed, and you also get treasury backed. So that's most risk to least risk in those, and those range in natural order, where the highest you get is going to be anything backed just by the full faith and credit of a bank itself. Those are going to yield anywhere from 4 to 5% in this type of environment. Government agency backed are going to yield somewhere in the same range, except they have a little bit more stability to them, oftentimes closer to 4%. And then treasury backs also around 4%, which are backed by ultra short-term treasuries. So think less than 1 year. Last type of cash alternative, at least from our perspective here at CFG, are going to be ultra short duration ETFs, which are used in our strategies fairly abundantly. We have 0 to 1 year treasuries, which will yield you around 5%, and then 0 to 3 month treasuries, which are yielding about 4.5%. Both very, very cheap to own in terms of internal operating expense, very, very liquid, no transaction or commissions associated with any of those. And then you also get the benefit with those particular types of investments of that flexibility and liquidity, where you can buy and sell and trade that out for a more risky position the same day that you sell perhaps your ETF and not have any issues in terms of running out of cash in the portfolio to settle the trade. Hopefully that helps everybody. Have an awesome weekend. Take care.